Welcome to the Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here today with a very special guest, a good friend of mine. His name is Jay Rinehart. Jay is not only just a great friend, he's like a big brother in business to me, and I'm very grateful that he's here to just share some wisdom with us and anyone that may be listening. So without further ado, Jay, how are you today?
Good morning, Michael. I'm doing great, man.
So where to begin? There's so many things that we could talk about, and I had a list of questions all prepared, and then I decided on the way over here this morning, I was like, this is my buddy Jay that I'm going to talk to. Let's just have a conversation and see where it goes. So for folks who may not know who you are, how would you describe yourself and what you do for a living?
Well, Michael, my world is an interesting world. I got my real estate license when I was about 3 weeks after my 18th birthday.
Yeah.
So people say, oh, well, you've been a realtor since then? Well, actually, I grew up in a real estate family. My mom and dad creating the company and starting their business when I was 6 years old.
Wow.
So I have grown up dealing with this thing that we call dirt and termite food. You know, it's real estate in every aspect of it. I've done everything from development to working with people on build to suits to now, I do mostly commercial brokerage and do what we're talking about today, investment real estate, helping coach people through how do I get started and then what should be the ultimate goal when I'm looking at this. And of course, that ultimate goal coming through our conversation with you as a client sitting across from me, because we have some people that say, hey, Jay, I've got an extra X number of dollars, $250,000, and I want to put that into real estate. What can I buy? And I always tell them, what is your goal? What do you want? What does this look like? No different than you're advising with somebody like me on what does a stock portfolio look like?
Sure.
What's your time frame? What's your horizon? Are we dealing with $250,000 when you're 70 years old? It's a very different investment than if I've got a 25-year-old.
Right.
So
that's a great way to approach that. Like, what's the goal? What do you find when you ask people that? Do you find yourself that where a lot of people are more enamored with the idea of being a real estate investor or wanting they have clear-cut goals and they just need somebody to help them get from point A to point B?
Well, the funniest one I get right now is, okay, I've watched HGTV and I want to be a flipper. That is the most common question I get from people today. And I just find that comical, okay? Yeah. Because most people don't understand what that takes, what it is, and a lot of the risk. There's a reason why people make a pretty high reward on those, because there's a massive amount of risk that they don't always put on the TV shows.
Sure. The TV shows are built for the successes, not for the failures, right?
Right. You got it. And so, when I start talking to people, I said, talk to me about the goal. You want to be a flipper. Why? Do you understand that flippers, it's ordinary income. It's not capital gains. And they go, whoa, wait a minute. I already make X number of dollars. Now it's going to be X plus? Yes. And that's paid at ordinary income rates. Sure. Oh, well, I don't know that I like that. Okay, then what is the goal? And for a lot of people, they say, I want to have $1 million in stocks. I want to have $1 million in real estate. That way they're saying, okay, that's a balanced portfolio. It gives me something there. Now, some people may say, I want to have $1 million in real estate and $250 in stocks, or I want to have vice versa, $250 in real estate and $1 million. Again, it's dependent on that person. Now, when you start looking at it, then you sit back and say, okay, if I want to have $1 million in real estate, is that, four $250,000 houses? Is it $100,000 houses? Is it a $500,000 small commercial? And 2 or 3 houses. I mean, it can be all over the place. And you start building that out. What does it look like and what kind of risk tolerance does the person have? Each type of portfolio is very different when you start talking about investing in real estate.
Of course. And do you find that there's a specific type of investing? Well, I think you just shared, like most people want to be a flipper. Mm-hmm. Do you find that that's because they are seeing it as a way to make quick cash, like, right. Initial investment, I put this little bit of elbow grease into the property, turn right around, and I make my return on my investment and I go to do it again.
Right.
Versus you find it's more of we want quick return of capital plus, or versus people who are really wanting to play the long game.
Right. See, I don't consider a flipper to be an investor.
Speculator.
That's right. I mean, they're buying a product. They have a amount that they want to put into it, and they believe that the return on that will pay for itself and to give them their income.
Great.
That's not an investor. An investor is a long-term investor, especially in real estate.
Right.
We've said it for many years. You don't day trade real estate. It's too expensive to buy. You have to have mortgages most of the time, or if you're buying with cash, then we need to talk a little about leverage, what that can do for you. There's just so many ways to look at investing in real estate. So it's very different, investor versus flipper. And I will tell you, the flipping is just sexy. I mean, you see it on TV, you get this nice high from buying it. But remember, Michael, let's say we've got a house that its fair market value is $200,000. In this marketplace, somebody's going to come in and pay $200,000 for that house. So why would a flipper be able to buy it for so much less, just slap a coat of paint on it, and then increase the price by 10%, 15%, 20%? You're not going to buy that house for $155,000.
Right. Unless there's something significantly wrong with it.
Well, I can tell you you're going to be outbid.
Right.
Because the person that's going to live there is also, they're going to bring their in-laws, and the in-laws are going to say, look, we'll come up next weekend, we'll paint the house. Hey, flooring is not that expensive to put in. Let's talk about how we do that.
Okay.
So in this marketplace, while there are opportunities to flip, it's not as easy as people say. And what's ended up happening is we're having people being pushed into higher priced houses. Mm-hmm. So they're looking at $300,000, $400,000 houses to try and flip.
Whew. Which seems to me, just listening to it, likely exponentially increases your risk, because we're not talking now about a property that you scooped up for $85,000 and you're going to try to flip it. You're talking about a property that might be $300,000 that we've got, and you're looking at a very specific type of buyer at that point.
Mm-hmm. You are correct. Now there are some areas of Rock Hill, especially over around Saluda, around downtown, where people have been able to go in and buy very low end houses. Mm-hmm. But I mean, Michael, you're not talking about just slapping a coat of paint on it. Right. Now you're talking about gutting that house. All new wiring, new electrical service, all new plumbing. They usually rip out all the interior walls and go back with sheetrock. I mean,
brand new.
Brand spanking new.
Basically, you're just starting with the bones.
Right, and they're buying some of these houses for $30,000, $40,000, and they're putting them back on the market at $150,000 and selling them. Mm-hmm. So there's a lot of benefit in there, but once you have that happen in a neighborhood 3 or 4 times, guess what happens to that base price?
Goes up.
Right. People aren't willing to sell them for $30,000 or $40,000.
There's one thing that I've always thought about too when it comes to the do-it-yourselfer, a real estate investor, be it a flipper or being someone who is going to intentionally purchase real estate for the sake of wanting to rent it out and be a landlord. Is I've always had this thought, and you might be able to shine some light on it. One of the things that always has made me nervous is for someone who may have capital but doesn't have a lot of like handyman skills, where you're going to have to contract out just about every project that needs to be done on the house. I mean, most of us can hold a paintbrush, but obviously it could take a professional painter a fraction of the time that it might take somebody to go in there on their weekends and do a paint job. So do you find having skills where you can do, handyman projects, are pretty effective, is that an asset to you as a real estate investor, or does that, not really make much of a difference?
Well, it depends. If I also have a 40-hour-a-week job, then having those skills so that I can go work all day Saturday might benefit me in a small flip when we've got, one tenancy ending and we just have to go in and clean, maybe do a little bit of touch up. That's great. You can do that on a Saturday morning. But in a situation where we may have a whole house remodel, where we're going in and putting in new carpet and painting the entire house, it could take you 4 or 5 days, which if you're only working one day a weekend, now we're at least 2 weekends,
right,
Saturday and Sunday, or if I'm only working one day a weekend, now I'm a month, and you've lost a month's worth of rental income just by doing it yourself, and you still have to pay for supplies. And what I find with so many people that say, okay, I'm just going to do the work, they don't value their time. They think, okay,
they think they're saving money just by doing it themselves, and it's going to be a better path for them versus getting some pros in there to turn it around for you quickly.
Right.
And make it income generating, whatever that may be.
Well, I talk to people when they're thinking about investing in something and they say, oh, well, it cash flows. I'm saying that is great if the investment cash flows. Now let's figure out what were your expenses. Did you include a management fee in there? No, I'm not paying a management fee. I said, well, technically you are. You're paying yourself to manage the property.
Right.
So you're basically valuing your time for zero.
Yeah, you're on call at 2 a.m.
Right. Yeah. And then when people wake up and they go, oh, wait a minute, I've got to figure that in. Then sometimes they won't cash flow once they start figuring in their own time. Once they figure in, okay, there's going to be a maintenance expense, and it's going to be one, yes, I'm going to do the work, but I need to value my time at X number of dollars an hour. And it's so funny, I'll have a professional that makes $100 an hour now saying, well, I'm going to go paint this house. And of course I look and go, okay,
right,
you just valued your time at what a painter may make, which some of them do make $100 an hour. I understand that. But I don't want you to undervalue your benefits in becoming an investor.
Which is, I think it's a very important consideration to make because, obviously, people listening can't see us, but you're sitting in here in your business suit. I'm sitting in here in my business suit, and I'm very capable of going out and doing some handyman projects. But it's like for my time that I would bill in financial advising or consultation with a client, or you yourself, are we carrying that same mindset over into the weekend where it's like now this is our leisure time, but I'm going to spend that time working on this project? Are we doing the math the same way? Because I think a lot of times business people we're coached, right, to think about what's your value of your time, but we don't use that same level of thinking when it comes to being hands-on with a project like that.
That's right, and especially if you get good at investing in real estate. Now, one of the other things that I think people make a big mistake in doing is only buying one rental property. So husband and wife sit down, or a young person sits down with their parents and they say, well, let's buy this one rental property and see how it goes. Well, if you buy one rental property, you're either 100% occupied or 100% vacant.
Right. Yeah, it's all or nothing.
It's all or nothing. Yeah. And you can assume that at least 1 month a year after this first year that I have a tenant in, I'm going to be vacant because I'm usually flipping and getting a new tenant in, and there's some time there. So when I sit down with new investors and say, okay, what's the plan? The plan is to get, like I started with, not one property. That's how we start, but to build a portfolio.
Okay.
What does that portfolio look like? Because once you get into about the 5 to 6 unit number, it's amazing how the cash flow kind of levels out on a monthly basis. It's very consistent because, if you take that, I'm going to be vacant 1 month out of every year, well, that means that about half the year I'm down a house.
Right.
So it's a real interesting way to build out a portfolio. And a lot of people also look at us and say, okay, well, I want to build, or I want to buy 5 units in that one neighborhood or that one complex, if it's a condo complex. We say, whoa, wait a minute. putting a lot of eggs in that one basket. Why don't we look around at other areas?
Right.
Look around in Fort Mill. Look around in Rock Hill. Look around in the south side, the north side. You know, they're all kinds of different opportunities, but you have to be very patient when you're investing in real estate too.
That was actually the next thing that was about to come out of my mouth. I was going to ask you, like, what qualities are really necessary to find, in your view, success with real estate investing? And it seems to, from what I'm hearing you say, is that patience is essential.
Patience is essential because even if I'm paying cash, remember I'm getting a cash flow off of that cash that I put into the house. Mm-hmm. If I'm not and I'm borrowing money, now I'm on a 20, 30-year amortization for paying off this mortgage and it being 100% cash flow to me. So when I invest, I'm really making my money on the buy side. So I'm looking for that opportunity. And, you know, as an investor, well, simple one, I'm helping a gentleman in Rock Hill, came to me and said, I have X number of dollars to invest and I want to have 5 rental units and I'd love to do it within 1 year. I said, okay, no problem. So from the time we buy our first one, then we're going to try within a year to deploy the cash for 5 of them. And he went, no, I want it from today. I said, well, be patient with me. I'll find you the deal and when it comes along. So it took me about 3 months to find the deal. And I called him up and he's like, I thought you'd never call back. I said, you got to give me time.
Right.
Here's the deal. Here's, in this case, it was an estate. Had just hit the market. It was what we jokingly call a dog property.
Right.
I mean, it was rough. But when we went over there, he could see the vision that I was casting. And I said, look, this should rent for somewhere around $1,100, $1,200 a month. We're going to buy it for this price. And in the end, you'll have about $125,000 into the house. By the time we were done with it, because we did some upgrading on cabinets and things like that, he was in about $130,000, but we rented it for $1,400 a month. So there are different ways of looking at it. In that case, he was very happy with the return and is very happy with the return. The person came in and actually entered into a multi-year lease instead of a single-year lease because they wanted to stay
really
there.
Liked it, yeah.
Yep, really liked it. And so when you look at that, well, we've been down about 6 months because I can't find another opportunity for him right now. We're in a market, you know, Michael, where we're seeing some crazy things from investors right now.
Explain that a little better. What would you say is some of the crazy things that you are seeing?
Well, you know, there is a cap to how much a renter will pay in rent.
Sure.
Okay.
Yeah.
I mean, we live in an area.
It stands to reason that people only have so much money that they can actually pay.
Well, if you think, okay, I've got this house and it should rent for $3,000 a month, how many people can pay $3,000 a month in rent?
Not a lot of people.
Not a lot. You're talking about household income well into the 6 figures, and that's assuming that they are going to spend essentially 30 to 35% on housing.
Right.
Well, the higher the income, they don't always spend that much on housing. It actually goes down. So you do have people that say, well, let me buy that. We like to stay in that range of really about $850 a month up to almost $2,000 a month with our investors. So when you start looking at that and we have people out buying $250,000 properties to then come in and rent them for $1,600, $1,700 a month, the math doesn't work. You're not getting enough of a return on that $250,000 risk,
right,
to be able to make it worthwhile. That's what we're starting to see. You're also starting to see investors competing with first-time home buyers, and that to me is an unhealthy market.
Wow.
When you start having an investor come in and say, "Okay, I'm going to put cash into this property that really should be going to a first-time homeowner that's going to take care of it. It's a neighborhood that probably already has enough of a percentage of rentals in it,
right?
Because you don't want to have a neighborhood that's 50-50. You want more homeowners than you have rentals in a lot of these startup or starting neighborhoods. So that's what's going on in our market right now. And I think the regular investor really has to work with a professional.
Right.
I mean, if you're looking at, well, let me just go look at for sale by owners. Okay, how's that going to work?
Right. Exactly.
How are you going to value the marketplace, and then what needs to be done? A lot of times you need a professional to take you through.
Well, we know from experience, there's always going to be a percentage of the population that is going to do it themselves.
Right.
I mean, if they could, they do brain surgery on themselves without hiring a professional. But for everybody else, someone comes in and speak with you, and one of the first things you're going to say, okay, well, what's the goal? And so the goal, and then they have a goal. Moving into like how things get implemented. I mean, what type of capital do you typically want to see someone have or have access to just get started? And we're not talking about someone who, hey, I want to go high end, but just somebody who a reasonable amount of working capital that they have access to get started, or at least give you enough rope for you to begin like going to work on their behalf.
Sure. Well, first thing I always sit down with anybody that comes in and says, look, I have this amount of money, I want to go invest. I always ask the question, okay, do you have 6 months worth of your individual expenses set aside in a savings account for an emergency fund?
Right.
We're not going to touch that money.
Yeah.
I mean, this is not investable cash. This is your emergency fund in case something disastrous happens, one of you lose your jobs, you have a child that gets sick, and you need to take the time off.
Right.
And that's an eye-opening experience for most people. They're like, well, no. I said, well, then we're going to take some of your investable cash, and now we're going to set it aside for that. And they, as long as they stay with me and they understand, most of the time they don't get mad. I have had some people just not call me back after that discussion.
Yeah, it's interesting. I've had similar experiences. Someone reached out not that long ago, and they'd come into some money. It was not a huge windfall, but it was a sizable windfall for a young family, and they had promptly done a few things that they wanted to do. Some of them were wants. Some of them were actually pretty savvy financial moves. They paid off some debts and some things.
That's good.
And then they called and they said, hey, we want to invest this money. And that was one of the first things I said to them. I said, well, in the conversation we just had, you told me about, this kid, needs braces coming up here. And number two right behind them is going to need, braces. So we already know there's an expense that's got to happen. Then we got to talk about your just emergency fund. And then long story short, the advice that I was starting to give them wasn't very sexy, like, okay, let's go do this and we can make this money. It was more of, let's be prudent with the money that we have and let's get you started working a program. And like you said, they thanked me for my time, but they never called me back.
Sure. Well, and it's the short-term versus the long-term view. What we're advising on is the long term. When you come to me for real estate advice, I have to help you get set up for a 20, 30-year investment horizon. Or even if let's say you're 50 years old and you're wanting a 15-year investment horizon that now produces cash flow for me, that's fine, but we've really got to look at how not to have you back in my office going, I got to sell this piece of real estate because I didn't prepare. So when you look at that, and that's the first conversation we have. The second conversation is, okay, in my world, you have to put somewhere between 20 and 25% down as an investor.
Gotcha.
So if we're going to buy a $150,000 house, you got to have a pretty good amount of capital to put down. Plus, I suggest, because the minute we close on it, I usually don't have a renter. We have a period of time that is a lease-up time frame. So I ask them to set aside another month to 2 months worth of their expenses. Now, if they're buying a house that needs work, okay, do we also have the money to put into painting, to doing, a kitchen remodel if we have to, fixing bathrooms, those types of things. So a lot of people come in and say, hey, I've got $25,000, let me go into the marketplace and buy a rental property. Well, you can. It just depends on what type of portfolio do you want to build?
Right.
Do you want to build a real strong portfolio? And I've shared with you before, my dad and mom and Dee Dee and I have two different types of portfolios. My sister and brother-in-law have a different type of portfolio. He's a doctor. I mean, the way they look at it is very different than Dee Dee and I. And Dee Dee and I, our portfolio has only been growing for, I guess, about 25 years, but Mom and Dad's has been growing for 45. So
Yeah.
very different time horizons, very different types of things we like to invest in. What I like is very different than my mom and dad, which is
Sure.
interesting. They raised me, been in this marketplace, but it's just different.
Mm-hmm.
And so you have to build what works for you. And the funny thing is, when all three couples, mom and dad, myself, and my sister, get across the finish line of our investment horizons, we'll all be very happy with them.
Right.
It's
Because
very interesting.
everyone was running their own race.
We're running our own race, and as long as it delivers, which ours is delivering, long term, the success will be there.
Now, one thing that I would want to ask, and I'm kind of going back to a comment you made earlier about just this marketplace, because where we are, the area that we are, we're in York County, South Carolina, south of Charlotte, North Carolina. It's fair to say, I think, one of the fastest growing areas in the country, period.
Well, in our area, it's fastest growing in South Carolina.
No question. I mean, we're growing so fast that our infrastructure, we have problems with the capacity already. But one of the things that I've always thought about when it comes to real estate investing is, if I'm looking at two properties and property A is pretty much ready to go, it might need some superficial, cosmetic type of stuff.
Sure.
And then property B has some issues. Traditionally, property B gets a discount because there's some issues. Are you finding that with how tight this real estate market is, that the property B is getting bid up just like any other property, and they know that because you need the space, that they're not really giving a much of a discount because
you're correct. I mean, once you go above that $85,000-$90,000 price range,
right,
then you're looking at multiple offers. Perfect example, we've had two properties come on the market about 3 weeks apart in the same neighborhood in Rock Hill. And one was priced a little bit lower and the other one more at fair market value. Again, the one priced lower was because the family wanted it sold.
Right.
It ended up with 7 offers over asking price, all for cash, in 24 hours.
That is insane.
And guess what happened? It sold about the same
It
number
got bid up,
as the one that was priced right.
Right.
Because it didn't. Now it had multiple offers, but they were not as much above asking price.
Sure.
I mean, and Michael, we're talking in this one $25,000-$30,000 above asking price is what it got bid up to.
Man,
so you start looking.
Congratulations
and
to the sellers, right?
But they sold about at the same price per square foot.
Sure.
So back to your question, that means that you're getting no discount for some work that had to be done.
Right.
Okay? Because people are saying, I got to have a place to live.
Exactly. And I think, I'm approaching it there because there's two very different conversations. I think the buyer that is, I need a place to live, versus the buyer that's the investor. And as you were saying, we now have investors that are competing with home buyers. Now, you specifically said first-time home buyers, but I just think where I think of, you want to try to make a wise purchase on the front end. As that seems like to me, would be getting harder and harder and harder to do that. So should real estate investors or people who want it, should they be thinking about being more patient, or should they just say, I'm going to have to wait perhaps longer than I want to wait to find the right deal for me to get started?
So let's talk about patience, because patience sometimes is misunderstood.
Okay.
Patience can be, okay, I'm just going to wait and sit on the sidelines. That's one type of patience. The other type of patience that we're encouraging investors to do is be ready. Be ready to fire. Have somebody that is looking in the marketplace for you all the time.
Gotcha.
And be ready to go. Because
have your ducks in a row, because you might get a phone call and we got to go now.
We got to go now. We got to go buy that house.
Right.
Because there are opportunities that come along. Okay? I mean, even in a marketplace like this, there are opportunities sometimes for portfolio sales. So let's take a situation where somebody owned 3 properties. Well, they want to sell, the family wants to sell them as 3 properties. They don't want to go into the marketplace, split it up.
They're
They just
looking
want it
for
to
an
be
investor.
done. They're looking for an investor. There are other ones now, too, where investors, remember our baby boomer investors are aging. And so sometimes they will come in and say, life change, now I want to get rid of my portfolio. And if we have an investor that we already know, because these are already rented properties, then we can go to that investor and say, hey, here's an opportunity, here's the price that we're looking at, and it's based on cash flow.
Gotcha.
So there's a lot of different ways to skin this cat. You don't always have to be just looking for that one-off property.
You know, what you just mentioned, it made me think of something that's, you know, one of the things in our industry that is talked about ad nauseum, and I say our industry, I mean financial services, is we have this abundance of advisors that are right around or very close to traditional retirement age.
Sure.
And one of the things that continues to be speculated about is what will the financial services industry do if all these people start retiring, and that it's combined with how many people actually have a succession plan for their business. And
Sure.
One of the things that we've talked about with our own business with some other people is possibly serving as a succession planning, you know, portal or group that older advisors, we could talk about possibly buying out their practice over time. I'm curious, and that's what made me curious, is like some of these people, let's say somebody, you have an investor who is very savvy, wants to work a plan, is following all like the instruction and is definitely taking the long view. And then you have one of these people that come up and say, hey, look, I want to sell this portfolio. Do you ever see transactions where there's some seller financed, you know, transition there, or is that even possible with real estate? Or, you know, because I would imagine some of these portfolios are held in like an LLC or some type of management,
Sure.
you know, entity where there could be a slow buyout over time versus like, you know, you got to go get the note from the bank and you got to get approved for the financing. You got to just take this off my hands because I'm ready to be done with it. Do you ever see any innovative ways to do that type of deal, or is it got to be, you know, you got to be ready and you got to have the money to do it?
Well, let's talk about a true real estate investor.
Okay.
Most true real estate investors hate to pay taxes.
Understood that.
So they rarely
That's
like to
investors
sell.
in general, I think.
I know, but they rarely like to sell their portfolio.
Right.
So it's not an unusual thing, but it's not a common thing. And the reason is, if they hold it till their death, guess what happens to basis?
Step up in basis.
Step up. Now, if the kids want to sell it, no tax.
Exactly.
So the other way that an investor will come in is they will say, okay, I'm going to sell my portfolio, but I'm going to do a 1031 tax-deferred exchange. And in that case, you can't have the seller financing. It's considered a boot, so that triggers tax. So it really, I mean, there are a lot of different ways to do it. If somebody is looking for a lot of investors too, especially if they're business people, you know this, they don't plan on their retirement very well.
No.
And so a lot of times people will get to this, they have invested in real estate, it has been their retirement plan, and now they got to figure out, how do I get my income stream? Mm-hmm. And so I want a little more than just the rents, so how do I get my income stream up? And sometimes that is a sale and a seller financing, which you'll see.
Okay.
So it's not that it never happens.
It's just not common.
It's not as common.
Sure.
Correct.
So I one of the things that we deal with and kind of it's an interesting dynamic sometimes, but we have folks that view the stock market as kind of a giant casino at times. And you know, and if you think about it, we can understand that simply because it tends to be very easy to get money into the market. And if you're investing in assets that have liquidity where you could go and sell them, I mean, you're in and out.
Right.
Real estate's not that way. I mean,
No.
you've got to have a strategic focus. It sounds, you know, from listening to it from the very beginning, you have to be thinking about it strategically, about my entry points, what type of portfolio I'm trying to actually build, and then also my exit strategy. Am I in this for like a really long term where I'm looking for long-term appreciation of property? Or if I am trying to be more of on the speculative side, like how do I mitigate that? Because as you mentioned, just a flipping of a house, even if you do make a nice return in the short run, we're paying ordinary income tax on that. So what is your advice, I guess you could say, to sum up everything for folks that are wanting to get involved in real estate? And should younger investors consider real estate as part of their overall wealth building plan? Because, before you start, the reason I asked about younger investors specifically, I was always raised in, I'm from the South, you're from the South, but I always heard, God's not making any more land. That was a common phrase. And so as we've seen this area grow up, I feel like sometimes I have a little bit of FOMO, like I've missed out on some of this development. Sure. What would you say to younger investors who are mulling, like, what do I do and how do I, get involved, and should I get involved in having real estate?
Sure. The growth that we've had comes along every 20 to 30 years. So for the younger investor that says, oh my goodness, I've missed this growth cycle, that would be like somebody in the late 80s saying, oh, there's never going to be another cycle. Mm-hmm. And we have some investors that bought properties in the 80s and 90s and have been sitting on them, watched the downturn happen, have watched their values come back, and then all of a sudden over the last couple of years watched their values double. And they're like, what in the world just happened? And their incomes obviously go up because as values go up, so do rents. Mm-hmm. So I always tell people, get in as early as you possibly can. Okay. With a plan. Again, if you and your wife had sat down with me when you were in your 20s and you said, look, we want to buy $1 million worth of real estate, think about how far into the mortgages you would be. I know you're not that old, right, but literally, you'd be a third of the way through if you had 30-year mortgages, potentially halfway through if you had 20s. And so now when especially if I buy at 25, if I'm 45, 50, now I've got cash flow and I can decide, do I continue investing or am I okay with that value of property that I have now as part of my retirement plan?
Makes so much sense. So if I could summarize it from everything I've learned in this brief conversation, the first thing we got to have is we got to have a plan or a strategy. We can't just say, hey, I have some money and I want to put it in real estate, because the first thing that they should be asked by somebody that's going to help them is, well, what's the end game? Like, why are we wanting to do this? Right. And then, we have to be prudent, not just, well, we have some money, but do you have the fundamentals taken care of? Do we have an emergency fund? Do you have money set aside? I mean, we're not basically taking every ounce of your liquidity and trying to put it in something that's not going to be a liquid investment for ourselves.
I always tell people, imagine this: the HVAC unit on your principal residence goes out and the HVAC unit on your rental house goes out.
Sounds like a fun day, fun week there for two HVAC units, but not outside the realm of possibility.
Right. And which one do you replace?
Sure.
Well, you're contractually obligated to replace the one on the rental house.
No question. And then, kind of summarizing is like, it's a process. We got to stay patient. And like you said, which I loved, was patience. Sometimes patience is, we have to look and be patient and not get antsy. But sometimes patience also means we're strategically waiting, but the phone could ring tomorrow with the deal, and we've got to be ready.
Right.
So and then of course for younger folks to definitely take an interest in this. If it's something that makes sense for you in your personal situation, get involved earlier, because this is truly one of those things where we got to put it in the oven and let it bake for a while. And the longer we defer that, the longer we are deferring our start, plus where we want to be. If we're working a plan, we're kicking that finish line down the road as well.
Right. You got it.
Awesome.
It's a great summary.
Well, Jay, thank you for coming in and being willing to share your wisdom. I'm going to have you back because there's just so much gold here to mine. But we're grateful for you and your expertise. And how could if anybody was listening and wanted to reach out and learn more or possibly talk to you about real estate investing, what's the best way to reach out to you?
Sure. Well, our website is rinehartrealty.com. That's RINEHARTREALTY.com. There you can take a look at new properties that are on the market. Take a look at the market. Just get familiar with it. My phone number at the office, our main line, is 803-329-3333, and my direct is 803-323-5605. And email is easy too. It's J, the letter J, D, as in David, Rinehart at rinehartrealty.com.
Perfect. Well, Again, Jay, thank you so much. And for those of you listening, you can find us on Facebook. Send us a note, themoneyhuddle@vcplanning.com. If there's a topic you want us to talk about, we'd be happy to have it on the show. If there's somebody you think should be on the show, don't hesitate to let us know. And as always, thank you for listening, and we'll talk to you next time.